Terrific. Well, it looks like we've had some folks join in, so we're pleased to have everybody here today. Thanks so much, everybody, for taking the time on a Thursday afternoon to join us here. We know your time is valuable, and so excited to have a good conversation here and touch on the topic of volatility and risk and how to mitigate those within your portfolio, and in particular how to handle those from an IRA and retirement account perspective. So Mark Peck speaking here from Rocket Dollar. I lead our business development and partnership team, joined by Ryan Andrews and Mark Khuri from Ariel Investment Management. We're going to be touching again on recession-resistant investing and how to reduce your retirement account's exposure to volatility. Very excited to touch on that topic. We think it's timely and very pertinent in today's market. A lot of different cross currents occurring in the macroeconomic and sort of global economy. And so, just want to be proactive in that investing approach and handling risk and making sure it has its place within the portfolio and you're conscious of it. So just going to get through an introduction here for each of us, give us a little bit of background on our firms and what we do. Then we're going to touch a little bit on where we are in the economic cycle. That's really where Ryan's expertise comes into play, and we'll let him sort of talk about what he's seeing out there. Then sort of understand how these assets and the conditions, what they mean for retirement investing, and how you can, once again, proactively plan for those contingencies within a retirement account. And then Mark Khuri is going to touch specifically on some of the asset classes themselves that do well in a volatile environment and how their individual characteristics really, give you great, strong returns while mitigating that risk profile. And at the end, we've got an opportunity for some Q&A. Please feel free to chat in any questions, any thoughts that you think of there. There's a function on the webinar where you should just be able to enter any comments or questions that you have. So hopefully we can get to all those and continue the dialogue. I do just have a brief disclaimer to read here for you today, just to remind everybody this is an informational only webinar, and obviously you want to get advice and consult with your own team before making any investment decisions. But Rocket Dollar Incorporated and its affiliates do not provide tax, legal, or accounting advice. This material has been prepared for informational purposes only. It is not intended to provide and should not be relied on for tax, legal, or investing advice. You should consult your own advisors before engaging in any transaction or investment. So thanks for your patience with that. We'll go ahead and tell you a little bit about Rocket Dollar. So Rocket Dollar is a fairly new company. We feel pretty strongly in the belief that retirement is changing. The way that folks should use their retirement accounts is evolving. Our goal is really to democratize alternative asset investing and to help folks get access to private assets and non-traded assets that have previously been very difficult to allocate and invest in a retirement account. Our endpoint goal is really to provide an efficient, simple, safe tool for people to take control of those retirement savings and allow them to invest in things like the Ariel Investment Recession-Resistant Fund. Could be real estate, private assets, all sorts of different alternatives that really allow you greater control and freedom than previously allowed. I'll turn it over to Ryan and Mark to tell you a little bit about themselves and Ariel Investment Management.
Awesome. Thanks, Mark. It's Ryan Andrews here. So I'll share just a couple minutes about my background and bio, and then we'll get more into the presentation. So I started my career on the institutional investment management side at PIMCO down in their Newport Beach office. They're the big bond and alternatives manager. And that experience really shaped me in that it gave me early exposure to the importance of macroeconomics in investing and kind of watching global markets and national markets instead of just looking at individual assets. So spent a number of years there at PIMCO. I was also an early employee at CrowdStreet, if anybody's familiar with that company. They were one of the early pioneers in really crowdfunding private real estate investing and commercial real estate investing online. And then the last several years, I launched and managed a construction debt fund where overall I was overseeing a $45 million real estate portfolio and managed capital markets for about 170 investors that we had as part of that fund. And so, really all along this, especially starting my career at PIMCO during the 2008 financial crisis, I really believed in the importance of preparing for a recession, of the impact of macroeconomics and monetary policy, in preparing your portfolio. And so when Mark and I met a number of years ago and started, kind of talking about real estate together and working on this idea, we had a lot of shared beliefs around preparing for a recession, what kind of assets do well in a recession, how real estate operates. And so we started working probably about a year and a half ago on what would become the recession-resistant fund. And we had this real shared belief around a lot of the indicators in the macroeconomic environment that were, telling us that it was a really good time to put an investment vehicle like this together. And so I'll get more into those factors in just a second, but Mark here will share his bio and background.
Great. Thanks, Ryan. Yeah, Mark Khuri here. So I started out in corporate finance, working as a financial analyst for a Fortune 500 company. That was in early 2000s. And then along the way, I began investing in real estate, on the side, which is how many people become real estate investors. That was in the mid 2000s. And I held and managed property through the recession. So firsthand experience seeing, the greatest downturn of our lifetime. And then by about 2009, my family and I had been pooling some capital together really to take advantage of one of the biggest discounts in our lifetime in real estate. And that's when I left corporate America to really pursue my passion for real estate. And what's interesting, along the way, I realized and learned and fell in love with self-directed IRAs and what they are and how you can utilize them as an investment vehicle. I opened an account and also learned that you can't actively invest and manage your own deals. So I'm glad I learned that early. Can get in trouble for doing that. So I needed a place to invest my retirement dollars. So I ended up going on, really what I call a 2-year educational spree. I attended many, many investment seminars and meetings. This is all in Southern California at the time. And started meeting a lot of very savvy real estate operators where I could invest my personal retirement self-directed IRA capital in real estate. And that's essentially how I got started in self-directed IRA investing, was needing a place to invest my capital and in an asset and real estate capacity, which I already had very passionate about and fell in love with. Fast forward over 10 years, as the slide shows here, Ryan and I as a management team, we've got over 25 years combined experience in real estate and investment management. We've been involved in over 200 real estate investments across 10 different asset classes, and we've managed and created over 50 real estate partnerships. I'm just happy to share with you today some of our beliefs and learnings along the way.
Great. Well, we like to start here. And so like a lot of investors, this is kind of what the economy looks like to us right now. Today, we're in the second longest expansion in U.S. history. And there's some storm clouds on the horizon. And matter of fact, in June, this current expansion that we're in will turn over to be the longest in U.S. history. It'll be over 10 years. And so we believe it's not just a question of if, it's a question of when. When is the next downturn or recession coming? And so as investment managers, we're watching several economic forces that could push the U.S. into recession. And while we could probably talk for hours on this subject, we'll just mention a few high-level indicators that we're watching right now. The first is we're watching the cost of living rise really rapidly, and the labor markets are also at full employment. And while full employment can be a good thing because it means rising wages, that can also, the impact of that can mean cost push inflation because wages is such a big input in goods and services that are sold in the economy. And so, it's the most important takeaway here is it's putting families under pressure. And so it's just an important indicator to watch. Second, the U.S. is in an affordable housing crisis. And I think we've all seen the cost of housing has increased massively over the last decade. And again, it's left many households under pressure. It's left many households, if they don't own real estate, it's left them behind. And this is a really important long-term trend that creates an opportunity for us as investors. So more about that in a minute, kind of through this presentation. Third, one of the biggest threats to the economy is monetary policy. And the speed at which the Fed raises interest rates or even changes its forward guidance, which forward guidance is kind of a fancy term for them coming out and telling us when they think they're going to change interest rates. And this alone could tip the economy into a recession. Some of what the Fed came out with in their recent meeting in this last month showed that the Fed is looking at a lot of indicators that look like a recession could be on the horizon. And so they tapped the brakes, so to speak, on raising interest rates. They said most likely no interest rate increases for the next year, and maybe there will be one in 2020. And so, they most likely wouldn't have done that if they didn't see weakening in the economy. And so, just another couple indicators. Then lastly, this is kind of a fun, or if not fun, at least an interesting one. On March 22nd, so just about a month ago, the yield curve inverted. And this was the first time it's inverted in a decade. And what that means is short-term interest rates on the 3-month Treasury note was above the interest rate on the 10-year Treasury note. And this is a commonly accepted and known leading indicator for a recession. So, matter of fact, an inverted yield curve has preceded each of the past 7 recessions. And that's been over the last 50 years. And so, just as an interesting stat, when the yield curve has inverted, a recession has followed between 200 and 400 days after that. And so, you're talking about 1 year later, typically a recession occurs. And so that's just an important indicator that, caught a lot of folks' attention at the end of last month. Given all these indicators, we truly believe now is the time to reduce investment risk. And so today we are investing in real estate that has a low correlation to market volatility. Specifically, we're selecting stabilized commercial real estate investments that generate immediate cash flow and which have a really strong value add component. And this means that we can improve the property and increase the net operating income rather than relying solely on market appreciation. Our strategy also focuses heavily on the long-term sustainable demand that's the result of the affordable housing crisis I mentioned a moment ago.
Yeah, thanks for that, guys. All really interesting points. And I think, they all come to a head oftentimes when somebody's constructing a portfolio. And in particular, in a retirement account portfolio, you've got some specific duration concerns and sort of everyone's got their own goals where they're trying to achieve. I think there's a couple of interesting times where assets, such as the ones that we're touching on today, really come into play. I think in my own situation, the way that I've invested my own self-directed account, I've got some pretty high risk, high reward opportunities with some startups and early stage companies that don't leave me with a lot of, good cushion or good mitigation of risk on the other side. So I think if you're, pursuing some high risk strategies, it's great to pair something like the recession resistant fund with those assets. That way that you're getting a more true baseline, with some concrete physical assets backing those things up, providing some yield and providing some income in a more consistent manner. So really just to smooth out your retirement return profile. I think it can be useful there, as well as, it can really help you focus in on specific geographies and specific asset classes, which is what Mark's going to touch on further. And that just really helps you, invest in what you know and what you feel comfortable with as well. And that's, I think, really important for folks who are actually nearing that retiree stage, right? As you look to transition your portfolio away from a stock heavy or growth heavy portfolio towards, more of an income generating, smooth return portfolio, it really helps to be able to tap into some specific asset classes and geographies and add those to your other pieces of the portfolio so that you've got, really true diversification, which is often so difficult to obtain in the public markets. So I think that's where we see, a couple really good use cases for these kind of assets within a retirement account.
Great.
So Mark, if you want to touch a little bit on some of those asset classes, I know we've got a few on the screen here. So go ahead and dive into specifics.
Yeah. So, again, about 14 years ago, I started investing in real estate at that time with just friends and family. And over the years, we've invested across lots of different asset classes, numerous strategies, flipping, buying and holding, rentals, etc. But today, and actually for the last couple of years, accounting for the economic headwinds that we've seen, and based on our experience, we've selected and narrowed down our investment focus to just 3 asset classes, which you can see on the screen. And those are mobile home parks, workforce apartment housing, and self-storage facilities. And our fund combines the 3 of them into one investment vehicle. So let's just review why do we love these 3? This chart's great. Over the last decade, our 3 asset classes have seen the highest net operating income growth when you compare them across 10 different types of real estate. And this is projected to continue. This is a chart from Green Street Advisors. So yeah, let's dive in a little more. Why these 3, and why are they continuing to show great NOI growth? We'll start with mobile home parks. Mobile home parks continue to be one of our favorite asset classes, and there's several reasons why. It comes back to the affordable housing crisis, which is apparent nationwide. I'm sure many listeners today have seen it and felt it in their backyard. But mobile home parks are the most affordable housing solution. And even recently, we've seen a surge in demand for mobile homes from baby boomers who are retiring on fixed incomes. Further, supply of mobile homes is restrained. This is due to zoning restrictions limiting the development of new mobile home park communities in desirable areas. Now, within the asset class, we focus on a unique business model where we want to own primarily just the land and not necessarily the homes. And lastly, mobile home parks are one of the highest cash flowing real estate assets, and they provide unique tax advantages, including accelerated depreciation. So here's a quick case study. It's always good to look at examples, I believe, but we began investing with a mobile home park operating partner over 6 years ago. And here on this slide, you can see we've summarized one of our investments, which consisted of an ownership in 15 mobile home parks across 6 states. It was a portfolio which provided consistent, predictable cash flow with a strong upside. That's really what we look for: diversification, like you said, Mark, predictable cash flow, in-place income. In this example, in 2008, our operating partner sold over 100 mobile home parks for over $340 million to a private real estate equity group, which provided investors over 13% IRR and 80% return on investment. So the second asset class we touched on was workforce apartments. Workforce housing also is an affordable housing solution. And when we talk about workforce apartments, what we're meaning and what we're referring to is rental housing apartments that can be reasonably afforded by the middle income local population. And workforce housing, often has high demand and consistent occupancy during an economic correction. A typical sweet spot, I like to just share with people is, estimate that the rental rate per month is going to be between $800 and $1,200 a month. So that's kind of how you can get an idea of the class of apartments we're talking about. And, further, with home ownership at its lowest rate in over 50 years, more and more people are choosing to live in apartments. This is an example that we made recently. This is in Austin, Texas, actually, Mark, in your backyard. It consists of a 284-unit institutional building. It's a community that was built in 2002. It's 7 miles from downtown Austin. And the property, when we bought it at acquisition, was 94% occupied and generating positive income. It is part of our recession-resistant fund. And a little bit about the business plan that we like to employ, which Ryan touched on, is renovation of the units and bringing them up as far as quality and to market. Prior to acquisition, 59 of these units had already been renovated by the previous owner, and they were generating over $200 more per month in rental income than the non-renovated units. So we had already had a pretty well-proven model at this facility to be able to come in and renovate the remainder of the units and the exterior grounds to increase the net operating income. The goal of this project is to raise the NOI from 2 million to about 3.4 million by year 7. So we're about the first few months into this project, and upgrades have already begun. And the first remodeled unit was rented out at $86 more per month than projected. So off to a good start, and love this apartment community. Another property here, another example, 2016, we invested in this 384 unit property in Richmond, Virginia. It was built in 1980, has 13 buildings on over 17 acres. And the value add business plan has grown the net operating income. So same concept, you come in, renovate units, provide a higher quality unit. And it resulted in a 13% increase in value of the property in just 2 years. So what you do after that, you grow the NOI, and then last year we refinanced the property, which returned to investors about 15% of our capital. Now we still own and invest in this property, and we have currently earning over 10.5% cash on cash annually at this facility. Okay, so the third asset class that we love, self-storage. You know, self-storage provides stability during a downturn. Let's talk about why and how. If you think about it, you know, during tough times, more people tend to have life events that result in a physical change, you know, requiring the need for storage. If you think about foreclosure or change in employment, downsizing, moving home from college, etc. All of those impacted demand for storage. And then one thing we really love, you know, due to the 30-day lease, self-storage can adjust to the market very quickly. And the demand is massive. 1 out of 11 Americans currently pay over $90 per month for storage. Now, if you look back during the Great Recession in 2008, the last bullet point on this slide, self-storage REITs were generating a 5% positive return, while general REITs realized a 38% loss. So you can imagine if you just held self-storage REITs, the outcome probably would have been much different for most investors in 2008. Okay, here's an example of a case study. We've been investing in self-storage for 6 or 7 years now with a national developer and asset manager that has over 45 years experience just in self-storage. They're estimated to collectively be the 28th largest operator of self-storage in the US. They've got over 30,000 total spaces. And their focus is primarily on value add self-storage facilities, which is what we love. And like all investments that we target for our fund, this example you see on the screen here was a value add opportunity where we increased physical occupancy and the gross rental income and took a 517 unit facility that we bought in 2015 for $7.5 million and sold it in 2018 for $8.7 million. So that provided investors with a 25% average annual return. Okay, we just wanted to also outline, you know, the performance of these 3 asset classes that demonstrates our experience. So this chart includes 26 investments that we've made just in our 3 asset classes. And what you'll see is as of the end of Q4, 7.7% was the average cash flow along the 20 investments that we currently still hold. That's from rental income. And then last year we had 5 investments exit. We just shared one with the self-storage facility. They all provided a 19.4% average internal rate of return. So Mark, want to turn it back over to you. Happy to answer any questions. And again, appreciate your time today.
Yeah, thanks so much, guys, for speaking on those use cases. I think it's really powerful to see the specific sort of examples of how those assets, you know, how they behave and what you can expect. I think, again, just to sort of bring it all back together, folks, I see we've got a couple of questions, you know, coming into the queue, so we appreciate that. But, you know, ultimately, really, you know, the Ryan and Mark's expertise here from an asset manager perspective is helping you apply some of those lessons and themes that Ryan touched on from a macroeconomic perspective, and just letting you drill down into the specific asset class. And I think that's what's so powerful about these opportunities is it's not, you know, a very high level generic traded REIT or something of that nature, but really getting access to something very specific that's uncorrelated to other aspects of the market. I think that's what we love so much about it from a retirement perspective. I know we get a lot of interest in all three of those asset class areas, and obviously for consolidated funds such as the recession-resistant fund. So thanks for the information there, guys. So I'll kick it off here. We've got a couple questions, and thanks again, and feel free to chat any new ones in if you guys can use the toolbar at the bottom of the webinar there. Thanks so much. But it looks like the first one here, probably going to give it to the aerial guys. So so since you've discussed a few different asset classes, Mark, is there one that stands out to you as the best opportunity for today's conditions, or maybe for the next couple of years?
Sure. Yeah, I would say mobile home parks. Lots of reasons, but essentially it's hard to find an investment where you have consistently growing demand and flat or decreasing supply. And when you put those two metrics together, it's just got a very long-term growth that we believe we'll see and experience for many, many years to come. Further, it's like we visited and we walk and we invest in a lot of different mobile home parks, but there's often a misconception about them as to what they're like, what the quality is, the resident base, the tenants, etc. And we were concerned about that many years ago before we started investing in mobile homes. But over the years, we've just learned so much more about the asset class and continue to love it more and more. Now, of course, there are some mobile home parks that are less attractive in less desirable areas that might be a little tougher to manage. We tend to steer away from some of the really heavy lifting properties. We're looking for highly desirable locations with a strong resident base. And essentially what you find there that I love is that they're really communities. Most of the residents know each other. They're very much in touch with each other on a day-to-day basis. They look out for each other. And it's just great to be able to walk them and talk to people that live there and see how much they appreciate being able to live and own in their home. Obviously, during a time where the cost of home ownership is just absolutely skyrocketed. So for some of those reasons, and we believe the long-term aspect of the asset class is extremely strong, I would say that mobile home parks are probably our favorite.
Yeah, that's interesting. You made a point before I hadn't considered before, which is the shifting demographics on the older age spectrum for mobile homes. I think some people, like you said, have preconceptions about the population there, but that's not something I would have thought of. And it makes a lot of sense, particularly in, overcrowded urban areas where you need some relief there. And the fixed income earner or the fixed income living folks in retirement, makes a lot of sense for them. So here, let me just check out the next question here. It's a little bit more focused towards Rocket Dollar. So question is, how does Rocket Dollar help me gain access through my retirement account to these asset classes? So it's a good question. At the end of the day, we are providing a tool and a service that's intended to empower the retirement account saver to truly craft a portfolio. So at Rocket Dollar, we really give the investor and the account holder the keys to the car to go out and allocate specific dollar amounts and specific pieces of the portfolio to assets in an individual fund manner or individual asset classes. I mean, ultimately, you could go out and you could be investing in a specific storage unit opportunity or direct real estate holding as well. Or what's often more common we see are folks are building a portfolio by investing a couple of different fund opportunities. So they're again being really specific and tactical, with some allocation to assets like we've talked on today, and as I mentioned earlier, maybe allocating towards some higher risk, higher reward potential opportunities as well. So we really just want to give you those tools through an IRA to be able to build a portfolio efficiently and to make it a very easy and tech-enabled process.
Mm-hmm. Great.
And it's great to hear your story as well, Mark, about how you got introduced to the space, and there's certainly a lot of ways to go about it. So it's always great to hear people's positive examples. Looks like we got one last question here. More for the aerial guys here. I'll give it back to you again here. And I think touching on interest rates. So the question is, how will changing or rising rates impact the approach? How do you see central reserve or central bank and Federal Reserve policy impacting the marketplace?
Yeah, good question. I'll share at kind of a philosophical level, and then maybe Mark can answer on how we actually underwrite deals to look at the debt structure and mitigate some of that risk. So interest rates in commercial real estate are connected, and they're really connected through changing of cap rates. So as interest rates go up, your commercial mortgage on a big commercial property, the cost of that debt financing goes up. And so in the investor that's buying that property later, let's say 5 years from now, in a higher interest rate environment, will pay less for that property. So he wants a higher cap rate in order to basically compensate for the higher cost of debt, because it leaves less cash for him as the investor at the end of the day for his equity that he's put in. And so there is a connection there between cap rates and interest rates, and therefore commercial real estate and interest rates. And so, it's something we do watch closely and kind of introduced early in the presentation. And so, the Fed appears to have taken a dovish stance, what's called a dovish stance in kind of the economic circles, which means they're not raising interest rates as aggressively as they had planned to. And that's because I think they've seen some softening in several sectors of the economy. And so, the Fed seems to be motivated to maintain asset prices right now. They don't want to see a big crash in asset prices, be it stocks or in real estate. And so I think they're trying to architect what we'd maybe call like a soft landing, where prices maybe level off a little bit and we don't see the heated appreciation that we've seen over the last couple of years. But it doesn't precipitate a crash in commercial real estate. And so, that's a little bit different trigger than a recession. A recession is technically a decrease in the GDP of the economy, and recessions and interest rates are often really connected, because if a recession occurs, then the Fed tends to slash interest rates. In the last recession, they did QE 1, 2, and 3, where they poured a bunch of money into the economy to try and save it. And so, all these factors, we don't know what's going to happen. We don't know the future. Nobody really does. But there's a lot of uncertainty. And so when there's a lot of uncertainty, we think it's really important to own conservative commercial real estate, real assets, where there's real value there. And one of the most important things we look at is a conservative debt structure on those assets. And so, maybe Mark here will share a little bit about how we look at that conservative debt structure, because it's an important piece of our investment picture.
Sure. Yeah. Like Ryan said, we just don't know what's going to happen. The volatility is changing every week. So I remember last year about this time, we were in the middle of a lot of interest rate spikes with, several more projected to come our way. And it wasn't necessarily a surprise. We've had very low interest rates for a long period of time now. So as investors, we're constantly looking at that as a target that's moving. And we've been projecting higher interest rates for several years now in our underwriting of assets and investments. But then as of recently, as Ryan noted, it seems like the Fed's taking a different stance, different approach. They may stay flat. And I just read another interesting prediction last week that the interest rates may go down this year. So who knows? But at the end of the day, what we do is we say, we are in a rising interest rate environment, and we have been for quite some time. So we kind of look at a macro level and just know where we are in that cycle and plan for interest rates to go up. So in the event that they do, how do we protect ourselves? Well, first thing we do is we look at the debt, like Ryan mentioned, of the asset. So we like 10-year fixed debt at a fixed interest rate. That's obviously a great way to secure today's low rates for the next decade. And then if we do have a variable or adjusting rate loan, maybe on a bridge loan where we might be coming in and doing a lot of renovations and upgrades to a property to increase the NOI. And then once that's complete, the bridge loan might come to maturation. We would want to see what happens after that. Are we forced into refinancing? And forced meaning with exorbitant fees, or the bank could call the loan due. We tend to avoid that situation. We want to, because who knows, 2-3 years when that loan matures, if it needs to be called due and you're not able to refinance because of a major change in the market or the economy, it could really pose a lot of trouble. And that's what happened to a lot of investors in the last recession. So we look for extension options of 1-2 years on that potential variable loan. We look for supplemental loan options if we've grown the NOI extensively. So we always try and protect on the debt side to make sure that we're not getting into an investment that has to refinance. It's always a great option to be able to take advantage of. But if you can't or aren't able to, you want to be able to just continue to incur and earn passive income by holding. Wait it out. That's essentially what we want to do. Secondarily, we look at exit cap rates very closely. And what that essentially means, and Ryan alluded to, is, if we're at a 4.5% interest rate today, and we're going in and acquiring an asset that has a capitalization rate at acquisition of 5.5%, let's say. If we're assuming that interest rates are going to go up, keeping all other things equal, we want to assume that the exit capitalization rate, or essentially the rate that the property is traded at in the future, is higher. So maybe 6.5%, 7%, to help absorb some of that potential interest rate spike. So by doing that, what you end up doing is essentially underwriting the investment conservatively, where you can take into account and plan for interest rate spike. Now, what's also happened over the last 7-8 years now, by doing that, but we've been in a declining, essentially, interest rate environment. So a lot of times you can outperform your projections because you got a little lucky, because you timed the interest rate market well, where you projected them to go up, but they actually went down. So you can resell the price for a little bit more than or resell the property for more than what you may have projected up front. So I think it's a very good question. A lot of people ask about interest rates, but essentially we like to mitigate that risk by planning for them to go up and really closely underwriting the debt to make sure that we're not in a situation where we ever become a distressed seller.
Yeah, it makes a lot of sense. Thanks for the responses there, guys. It looks like that covers our Q&A for today. But all really terrific information. And, I think there's a lot that can be gleaned from those comments, whether you're an individual investor who wants to go out there and, maybe strike out on their own and try and take on some of these assets directly. There's a lot to be learned and applied there, as well as, participating in the fund structure that we've highlighted, just because it rolls everything up into a very achievable and approachable way to access the markets. So really appreciate you guys joining us here today. Thanks so much for taking your time, everybody, for joining us here at Rocket Dollar and the guys from Ariel Investment Management. Love the color and the commentary from your guys' side. And, we look forward to checking in with you here later and seeing how all these things shake out here over the next couple of years.
Thanks, Mark.
Sounds great. Thanks, guys.
Bye. Thanks, everybody, for joining. Have a wonderful day.